All right, we're talking with Pat in California. Pat, you're with Allworth Money Matters.
Hi, Scott and Pat.
Hi, Pat.
I guess it's St. Patrick's Day, so Pat, you and I are celebrating.
The day we're recording this, yes,
Yes,
St.
yes.
Patty's Day.
Yes, are you wearing green?
Not
You get pinched, right?
Nope, not me. I just don't play that game.
Well, anyway, I wanted to thank you guys. I actually called a couple months ago, and you advised me to start interviewing financial advisors, and so I've started that process. And of course, I'm learning more and more stuff like crazy. Unfortunately, it seems to be making it more complicated than I had my more simple spreadsheets had predicted. So I came up with a couple of things that I thought I'd ask you about. Okay. And by the way, I'm talking to one of your guys next week, so we'll see how that goes. Well, again, thanks for that recommendation.
Well, thanks for putting us in the mix.
You guys for 30 plus years, probably, or 30 years
good.
or so. So,
yeah. Well, maybe it'll take another 30 years to really build that trust.
What's your questions for us?
Yeah, so I turn 70 next month. I'll start Social Security. I've got about $3 million in IRAs pre-tax. My really post-tax, after-tax net worth is in a couple of houses. My house and a house I got some kids living in, and then I've got another house I'm buying to help another kid live in. They'll pay me some rent to have some retirement income from that, but then they'll inherit and all of that. Now, I talked to you about that last time.
And so, so I don't recall the phone call.
Oh, that's okay.
But I assume we told you to make sure that these homes were identified in the trust in order to make sure that they go to the right places.
And we've got a trust.
Okay.
And we got a will, and all of that's kind of laid out and everything. But so one of the things I learned that I hadn't really thought about or planned about, I never really thought Roth IRAs really would apply to me, because I kind of always felt that, it's all about, do you think that taxes are going to be more in the future or more now? And so if you think that taxes are going to be less in the future, well then, or less now than it will be in the future, then do Roth conversions or Roth IRAs so that you pay less tax in the long run.
That can be the case, but really what you're trying to do is you're
looking at your tax
rate. And so,
well,
are you moving up when you do the calculation, this $3 million, right? You're going to have to start taking distributions in a few years.
Yes.
What's the value then? And then what's my required minimum distribution rate at that point in time, right? And am I moving myself into a higher marginal tax rate than I am today? And what you're trying to do is take advantage of that gap. And by the way, because of how IRAs are inherited by your children at some point in time, they have to drain that money in 10 years.
No more lifetime spread.
Which means it becomes even more importantly over the lifetime of the account.
Yeah, so what I learned about was this idea of, I guess the guy that I talked to called it the RMD bomb.
Okay.
Basically, you hit a point where the RMD percentage, as it continues to go up, it gets to a point where you have to take a lot more out than you need.
That's right. And
then you wind up paying a higher tax rate.
That's correct.
And so I could be in that situation where it jumps, from 22 or 24% to 32%.
That's correct.
And so you suggest, and then also, like you said, the other thing is that if the amount that you're leaving is an inheritance, because they have to take it out over 10 years, that could be a bigger tax hit on your kids than maybe you otherwise thought it would be.
Yeah. There's been a couple changes in the last even 5 years. So one, it used to be that the people who inherited the assets could stretch the withdrawals out over their lifetime. So you pass away, you leave a 60-year-old an IRA, they can spread it out over the next 25, 30 years. That's gone. Now it has to be distributed in 10 years. The second thing is the required minimum distribution start date, it got pushed up to 7, it's moving up to 75, but there's no increase in life expectancy. So
the distribution as a percentage becomes higher when you first do it versus age 70 and a half. So what is your income today?
Yeah, my income today is around $260.
And one more thing on because I just get some clarity on this, that the formula that's used to determine your required minimum distribution is not it's not a male life expectancy. It's not a unisex life expectancy. It's a life expectancy table between unisex your age and unisex someone 10 years younger. That's the uniform table for whatever reason. That's how between the IRS and Congress, that's how this formula was derived. But that's what. So when you start thinking about as you get older in life, your life expectancy comes shorter, which is going to trigger higher required minimum distributions. But it's not really just your life expectancy. It's a joint life expectancy between you and a hypothetical person 10 years your junior.
So when I start minimum required distributions, which is the year after I turn 73, so when I turn 74, it turns out that the number in the table is 25.6 and the percentage is 3.91, and that's fine. That's fairly close to what I think I'm going to need to draw, actually a little less, but then it goes up until it becomes 9.26 at age 92. Now, I don't know if I'll make it to 92.
Yeah, but
you know, you gotta, when you plan, you gotta pick a time horizon, right?
Yeah, and you're married, correct?
Correct.
All right.
And
so
you're in California?
Yeah.
And are your kids in California?
3 out of 4.
And you're going to stay in California?
Yes.
So you've got a lot of room for Roth conversions between now and then.
Yeah, so that's the thing. I never, like I said, the whole deal was I never thought about it before, but all of a sudden it becomes now a strategy for reducing how much I wind up with at the end in pre-tax.
Right. That's right.
In pre-tax money. And so now my question becomes, so if I start doing, you know, some Roth conversions to sort of manage that down, how do I think about that money? So when I'm thinking about withdrawing from my IRAs, I have to think about sort of 2 buckets, right? Some that's in.
Are we talking about after you've done the Roth conversions?
Well, I'm just talking about when I have to start taking my RMDs.
Yes.
I don't want, like right now, while I'm still have been in the contribution phase. Because I have Air Force pension. I start Social Security next month, things like that, and I have a good income. I've been 100% pretty much, you know, maybe let's call it 95% in the market in my IRAs.
Okay.
But now I'm looking at, you know, I'm actually still working. I'm going to retire November 15th, 2027 So I got just a little under 3 years left.
And how much is your income at your work? How much is of your 260 your wage?
Yeah, I'm a sole proprietor. I have a consulting business with the state of California. So I'm actually going to halftime. I have 2 contracts right now. You know, all the details. But
do you have a?
It's about 160.
Do you have
It'll be about 160.
Do you have a pension plan with your work?
No. Well, I have a SEP IRA with my business. My consulting business. I have a pension. I'm a retired Air Force.
You can funnel a boatload into a Roth just off that. You can do a solo K, which is very minimal, or you can set up like a cash balance traditional pension plan for yourself and funnel a couple $100,000 into a Roth.
Yeah, I have another little complexity with that where because I'm cutting down to half time, then I don't have the excess for these next 3 years that I have had. I've been contributing the max that I could in a SEP IRA.
And you don't have a lot of cash outside of retirement accounts.
I don't have a lot of cash outside. I just have enough for we have another little complexity where we're buying a house for one of our our kids to rent, and so that kind of thing.
Pat, so your question for us is?
Well, it has to do with the Roth IRA. So I've been trying to plot out, so how does my investment strategy in my IRA change as I shift from from kind of contribution mode
Oh,
to withdrawal mode. But then, I kind of thought, okay, I've got to have about a quarter of that in cash instead of being all in the market, so that I don't have to sell stuff. Well, like if this year turns out to be a down year,
I get it.
Yeah, but you can always you can do like for like. So the cash goes in a Roth, and you buy the same securities you just sold, and you haven't missed out.
But understand what you're saying is, but when I go to take the RMDs, should I because you have no money outside the IRAs,
pay the taxes.
You've got to pay the taxes, so you would manage to that. Absolutely.
Absolutely.
You would manage. So here's what would happen. So like if you sit down with an advisor and you go, okay, this RMD, this needs to be converted into a Roth between now and the thing that, and by the way, we're going to plan for that tax liability when you take the RMD, even if you're not going to spend it. So your RMD comes up and it's 4%. Let's say the account balance at that point in time is $4 million. It's $160,000 and you live in the state of California. We figure out that you're in about a 40% tax bracket. I would manage that portfolio 60% equities and 40% or 35% fixed income. And then
in the IRA.
And then when the required minimum distribution comes out, they send the money directly to the tax man. You don't ever touch it. And so you're using that bond portion. And then you're buying back similar or identical positions in the brokerage account on the other end.
Or it goes into a Roth.
I see what you're saying.
You can't, once you're on the RMDs, you can't move that to a Roth.
You can't move that. So I'm talking about when the RMDs happen.
Take out a little bit more than the RMD. Whatever it is I'm going to put in the Roth is going to be more than the RMD plus the taxes.
Okay, yeah, well, that's with the advisor to determine what that amount is. But your idea that I'm managing the money differently because of this tax liability is spot on. It's 100% spot on, which is you don't want the volatility of an equity portfolio knowing that you've got a tax bill coming due in 3 years or 4 years, right? And it sticks with this investment.
Although I can make the argument that it would be a lower tax liability because it can be based upon the value of the account. Although the worst would be
the market falls 40%
after the 12/31, and there's your RMD is one number, and what your value securities are. So
you could cut the difference. You could split the difference as long as you know what it is, right? But it has everything to do with what the timeline in the investment is, and so even though you might not be spending the RMD, you want to account for the tax liability for the RMD.
But you might have spent the RMD once she's quit not working.
But then that would drive the portfolio somewhere different as well.
My guess is you'll be spending some of these dollars from your retirement account once you quit having a wage.
Oh, absolutely. That's the thing. I mean, I have friends who say, like state of California employees, and say, well, my pension's going to be so much between that and Social Security, I don't even actually need any of my IRA money to live on, but I'll need to basically replace that $160K a year wage with my minus the Social Security with my IRA withdrawals until my RMD starts.
Okay, well then what happens is I pretty much could tell you probably where you're going to end up. You're going to end up at a 70-30 or 60-40 somewhere in their portfolio, and then you're going to start your RMDs on a monthly basis. And then every time that money comes out, and what happens is we use the rebalance of the portfolio to take into account that required minimum distribution on a monthly basis.
Okay.
Right?
And you do it monthly.
Oh, we do it monthly. We run the portfolios through screens on a weekly basis to make sure that we're tracking against our underlying index, but you're constantly making adjustments. So I think you're making a bigger deal out of this than it needs to be.
Okay.
What you should be concentrated right now is how much I should be doing in Roth conversions today.
There, you just need to run the numbers.
And I figure, and I'm not worried about, you guys trying to figure that out on the phone, but the last question I had for you was, so because I'll be withdrawing from the IRA, I get that has to be split, like you said, 70-30, 60-40, something like that, so that I don't wind up, having to sell stuff to take withdrawals, right?
Thank you.
It's the wrong time. But the other question is, now I'm putting I never really considered the Roth because I only have like a tiny bit in a Roth because way back when, somewhere along the line, I was able to put something in a Roth. But now if I start contributing, 20, 30, 40, 50,000 a year or something like that into a Roth, that's I'm kind of assuming that the Roth I'm never going to spend. It's going to be inherited.
Thank you.
And so I can leave that basically 100% in the market because at time horizon 20 plus years. Am I right on that?
100%.
Thank you. You are absolutely right. You are.
Well, I'm listening, okay, and I'm trying to.
You're absolutely right.
I think I'm learning, But,
no.
Okay, that was the big question.
No, you would, because the timeline for that particular investment, and you blend it. I mean, that's what the advisor does, right? So even though your IRA may be 70-30, your overall portfolio may be, depending upon how much ends up in the Roth, might be 85-15. Right.
Sure, I got you.
Right.
Yeah,
and so
depending on how it goes over time.
Yeah, and a lot of it just depends on, how comfortable with volatility and the risk premium in terms of ups and downs, which you sound like, you kind of got it together. And now what we're doing is we're cleaning.
Someone could have it together even if they don't want that much risk in their portfolio, Pat.
Okay, I guess that's my view of the world. Huh?
You got it together.
Okay, well, I'm just trying to make him feel good. No, you're 100%, Pat. You're 100% spot on. You're 100% spot on.
Well, that's good to know.
And the advisor's gonna build a model that actually shows you, and then they're gonna update that model on a couple, 2-3 times a year to make sure that you're on track, right? In terms of the Roth contributions.
And one of the things that you need to take into consideration, at least, is the impact on your Medicare premiums, the IRMA tax.
Yeah, because I'm already at 2x, and it's because I'm taking some money to buy this house, converting basically pre-tax to after-tax house.
You're already taking money out now, so. How much you taking out?
Well, it's kind of a separate deal, just specifically for this house.
But it's not, because it impacts what you may or may not be able to do for a Roth conversion.
That's your advisor will actually walk you through that,
because that flows through on your tax return.
I'm gonna be at near the 24% mark, and so I'm not going to go over that. So it's kind of like, what do I need for the house? What's my income that year?
That's right.
And then what's the gap up to that 24? Because the next thing jumps to 32, which is crazy, right?
That's right.
So that'll determine how much I can do for the Roth.
So what happens is you could actually do. I mean, the financial planning process is highly dynamic. I mean, it's highly dynamic where you'll sit in an office with an advisor, and they will have
or on Zoom
or Zoom and collect all this information from you. And, these are your hopes and dreams. This is what you want to do. And then present it to you on a large screen that says, okay, well, what happens if we did this? And it's dynamic. It's taking place while you're in the meeting, where you could you could say, well, what happens if I want to spend another $30,000 a year on consumables or big vacations or whatever? They would actually just run you through the case study. It's super dynamic, right? Rather than us sitting here guessing, you going in, and I'm hopeful that you met with other advisors. They went through a dynamic planning process with you as well.
Yeah.
So yeah.
And one that I talked to, they kind of wanted they gave me a basic idea, asked me a bunch of questions, and said they'd come up with a plan. But that plan you kind of have to pay for up front. But then if you go ahead and put your money with us in management, then we waive that fee.
Yes.
So it makes sense. It made sense to me, and the guy seemed like he was a pretty good guy. So can I ask you a question that would kind of be a pitch for your company a little bit?
Sure.
I mean, kind of like what I'm asking is so one of the things, like the guy I met with a few weeks ago is he said, so asset management's a big piece of any advisor's job, but we do all these other things as well. So tax advice and estate planning advice and all these other things. So he kind of built a little bubble picture in a circle with all the different things. And so are you guys primarily asset management, or you have that sort of whole picture kind of thing?
I don't know how many accountants we have working at the firm.
Right.
A number, like probably in the dozens.
And I'm not going to get a pitch for Allworth. Here's where the industry is headed.
Every part of it.
This is where the wealth management, financial planning, whatever you want to call it, this is where our industry is headed. historically, and Pat, even when we started, we did some financial planning, but it was highly investment driven and the financial planning. As time has gone on, you're seeing consolidation in the independent wealth space. First of all, there are more accounts now with independent wealth advisors than there are at the big firms.
Like Merrill Lynch or Morgan Stanley.
Most of those they'll state right on their website they don't provide tax advice, so they're a bit limited in what they can provide. But what's happened is there's been consolidation in this space, primarily as a way to offer greater services to clients. So Allworth, and there's many of other companies like that today. Matter of fact, you look at the top 20 largest RIAs in the country,
which we're number 15, I think, or something like
somewhere
that.
in there. I don't know the number, and
I don't
remember. It's Barron's or one of those. Hopefully on our website it's somewhere to we don't get in trouble from the regulators. In any case, the large firms, almost all of them now
offer
tax preparation, tax planning, estate planning, sometimes estate preparation, insurance analysis, insurance planning, sometimes fulfillment on insurance.
401k plans for small businesses, right? And so we didn't offer
Medicare
all that
planning.
We didn't offer that 10 years ago, but as we, like many of others of our competitors, have gotten larger, you can, I don't know how many advisors we have at the firm, 200 and something?
Like 100 and something.
I have no idea what. There was a lot of people at the conference a couple of weeks ago. I knew that. But the idea is that you could actually offer these services in-house because you can spread those costs over a larger number of clients and a number of advisors. Where 10 years ago, if you came to a firm like ours, we would be working with a third-party attorney.
That's right.
Sometimes we still do. I mean, we're appropriate. We'll work with your attorney and we'll work with your accountant.
It's
up to you. But if you want, then we will offer the services. And it's just the way the industry's going to go.
And the consolidation, we've rolled in a number of firms. Same thing with all the large firms. There's this massive consolidation because all the tools that can be provided for the end client today, the services are so much greater than they were. We've talked about, Pat, in the previous direct indexing and how technology does tax loss harvesting, and technology has made things so much more efficient and effective. The reality is an advisor today can serve more clients, be much more effective, and that's just where it's what the clients demand.
It's the marketplace. It's what
the
competition.
That's right.